What's up everyone and welcome to the channel. In today's video, I'm going to talk about one stock that you should avoid to save your money no matter what. But before we proceed to the video, don't forget to subscribe to my channel and like the video. Stock market is a place where investors can earn huge returns, but it's also a place where a person can lose all their money if not played smartly. We need to invest in companies with good fundamentals and financials to earn profits. The one company that's hugely hyped in the current market is GameStop. GameStop is a company that gained attention for all the wrong reasons in the stock market. In the last 12 months, GameStop has risen over 5,000% to reach $17 billion in market capitalization. The rise seems to be predominantly driven by a short squeeze rather than fundamentals that only involve shrinked revenues and compressed margins. Nothing related to its business operations was announced. Yet, GameStop rose at an astronomical rate in 2021, reaching a 52-week high of $483 compared to its 52-week low of $2.57. There are a lot of reasons to stop investing in GameStop. Let us discuss about them in detail. GameStop built a nationwide footprint by becoming a place to buy the latest video game releases. It also made itself a hub where people could buy, sell, and trade games, consoles, and accessories, and find other merchandise. This model made it a successful company until game makers began to sell their games via online downloads. With that change, GameStop lost much of its reason to even exist. Since then, the company's stock price and its fortune has been falling. These struggles have also affected GameStop's top-level management. In Feb, the company appointed a new chief technology officer, and the chief financial officer announced that he would resign in March. The company closed over 800 stores between the beginning of 2019 and the first 9 months of 2020. Quite a change for a company with 5,000 locations. It also expanded product and category extensions, such as comics and other type of collectibles, to increase the size of its addressable market. For many years now, this business model doesn't work. The financial performance is too poor, I call it dramatic. What is the competitive advantage that GameStop has? Its financial results during the past years are getting worse. It's an unprofitable company. Yes, GameStop has taken decision to change its business model, but I don't think it can transform itself into a profitable business real soon. Even before the pandemic, GameStop's revenue started to decline. In 2016, it reported a revenue of $9.36 billion for fiscal year 2015. Ever since that report, for each year until today, the company reported a lower revenue. In 2020, amid the pandemic, revenue was $6.47 billion. GameStop started having a decline in its net income in 2017. But at least it had it positive, though it had declining net income in 2017 and 2018. The last time it reported positive net income was in 2018, with a figure of $230 million. In 2019, a huge loss of $798 million was reported. In 2020, it suffered a net loss of $464 million. In 2016, GameStop had a debt-to-equity ratio of 0.17, and in 2020, this ratio went up to 1.55. And as per the latest quarter, the ratio stood up at 2.22. Increased debt with poor financial performance is a very risky mix. Now let's take a look at shareholders' equity. It is a very important financial metric to monitor as it provides information about the financial performance of a stock. Book value is widely used for valuation purposes, and higher numbers are always desirable rather than lower numbers. A company that performs well should increase its shareholders' equity over time. GameStop had a shareholder equity of $2 billion in 2016, but in 2020, the figure reported was $611 million, which clearly shows that shareholders' equity has collapsed over time. I would expect an official press release by the company to state that its erratic stock price during the recent period has nothing to do with any material information or corporate event. The company's management did nothing to inform the public about the news. Instead, it enjoyed free publicity for its stock and it got an artificially inflated valuation and market capitalization. Another factor hurting long-term investors is that GameStop possesses trading momentum and has separated GameStop stock from these fundamentals. This began when a group of investors on Reddit and Wall Street Bets site noticed large bets against GameStop stock by hedge funds in anticipation of the company's failure. Seeing a potential opportunity, some investors began to buy. This led to a run-up in the stock to record levels. That surge took GameStop from about $19 per share at the beginning of the year to a peak of $483 per share by January 28. It then fell to a low of $40 per share by February 23rd. At that point, shareholders would own a declining retailer struggling to redefine itself through omnichannel sales. Investors tend to buy stocks because they expect higher returns, not merely because the company finds a way to survive. For this reason, an end to the speculation will probably not bode well for GameStop stock. GameStop is attempting to transform itself into an e-commerce company to keep up with the times. But the success of that transformation is far from a sure thing. More and more console makers like Microsoft and Sony are working with the content creators like Electronic Arts to offer games and subscriptions directly through Xbox and PlayStation. This makes GameStop's core business significantly less durable. We can always check back in on a company every few months to see if things have changed. As of now, GameStop offers far more potential risk and headache than upside. GameStop remains a retailer in decline, regardless of the encouraging growth rates in online sales to offer hope for its survival. However, speculation rarely lasts for long periods. Hence, long-term investors need to make decisions based on fundamentals, which now points to possible survival rather than likely prosperity, unless the company can find a way to move beyond treading water. Any position in GameStop looks more like a bet than an investment. For all the arguments explained above, which are based on financial data, I believe the recent rally in GameStop stock is a pure stock bubble. I find no reason to buy the stock, and investors and traders should be very careful as it's a very risky stock with no catalyst to support it. Thank you for watching the video. Please don't forget to subscribe to our channel and like the video.